By the end of this video, you'll know exactly how to build real passive income through dividend investing, even if you've never bought a single stock. I'm going to walk you through 3 proven strategies that real people use to generate hundreds or even thousands of dollars every single month in dividend income. And the third strategy? Most beginners skip it entirely, but it's the reason the wealthy keep getting wealthier while everyone else just waits. So grab a coffee, find a comfortable spot, and let's build your income stream together. Here's where we start. The first thing you need to understand about dividend investing is that it's not about gambling on the next hot stock. It's about owning pieces of real businesses that print money and share it with you. Companies that pay dividends aren't just startups hoping to hit it big someday. These are established companies with predictable revenue, strong balance sheets, and a long track record of returning cash to shareholders. Think of it this way. When you buy a dividend stock, you're essentially becoming a silent partner in a business. Every quarter, that company sends you a check simply because you own a piece of it. That check is your dividend income, and it shows up whether the stock price goes up, down, or sideways. That consistency is what makes dividend investing so powerful for beginners, because even on the worst days in the market, your income keeps flowing. Here's the first strategy that works every single time. Focus on companies called Dividend Aristocrats. These are businesses that have not only paid a dividend consistently, but have actually increased it every single year for at least 25 consecutive years. That means they didn't just survive rough patches in the economy. They actually grew their payouts through the 2008 financial crisis, through a global pandemic, and through every other storm that came along. Some of the most well-known dividend aristocrats include Johnson & Johnson, Procter Gamble, and Coca-Cola. Johnson & Johnson has increased its dividend for 61 consecutive years. 61. Think about that for a second. That company has been growing its payout to shareholders since before Richard Nixon was president. Coca-Cola has paid and grown its dividend for 62 consecutive years. Procter and Gamble for 67. When you buy from companies like these, you're buying from businesses that have proven again and again that they can weather any economic environment while still rewarding their owners. Now let's make this concrete with a real example. Say you invest $10,000 across 5 different dividend aristocrats that average a 3% annual yield. That $10,000 generates roughly $300 per year in dividend income just sitting there. Now here's where most people stop listening. The S&P 500 as a whole has historically delivered around 1.5 to 2% dividend yield on average over the past several decades. But dividend aristocrats regularly deliver 3 to 4%, sometimes more. And because these companies keep raising their dividends, that 3% yield on cost today could become 5% or 6% yield on cost 5 years from now. That's the snowball effect. Your income grows not because you invested more money, but because the company is sharing more of its growing profits with you. Okay, so the first strategy is solid. Buy dividend aristocrats, collect growing income, sleep well at night. But here's where it gets more interesting. Strategy number 2 is about leveling up your yield without taking on unreasonable risk. And that means looking at dividend ETFs, which are funds that hold baskets of dividend-paying stocks all bundled together. With a single purchase, you get instant diversification across dozens or even hundreds of companies. One of the most popular dividend ETFs is the Vanguard High Dividend Yield ETF, or VYM. That fund holds a broad collection of companies and currently delivers a dividend yield around 3.5 to 4%. Its expense ratio is extremely low, which means very little of your money is being eaten away by fund fees year after year. Another standout is the Schwab US Dividend Equity ETF, ticker CHD. Since its launch in late 2011, CHD has delivered strong total returns while maintaining a dividend yield around 3.5%. In 2023, it was one of the top performing dividend ETFs in the entire market. The real advantage of these ETFs is that they do the heavy lifting of selecting quality dividend payers for you. You don't have to research individual companies. You don't have to watch quarterly earnings reports. You just buy the fund, set it up, and watch the dividends roll in. But here's the nuance most beginners miss. A high yield isn't always good. Some funds chase extremely high yields by loading up on risky companies that are barely staying afloat. Those yields often come with traps, like sudden dividend cuts that crash the share price. The smarter play is targeting funds that balance a solid yield with a history of consistent performance. SCHD, for example, screens for companies with a track record of consistently growing dividends, strong financial health, and reasonable valuations. That's the trifecta. If you're finding this helpful so far, hit subscribe. I drop videos exactly like this every single week, and there's something even better coming up next. Now, for the strategy that nobody talks about, but that might be the single most powerful wealth building tool available to everyday investors. Strategy number 3 is the dividend reinvestment plan, also called DRIP. Here's how it works. Most brokerage platforms, including Fidelity, Schwab, and others, will let you opt in to automatically reinvest your dividends the moment they hit your account. Instead of receiving a check and spending it, every dividend dollar gets automatically turned right back into more shares of the fund or stock you own. That means your dividends buy new shares, which then generate their own dividends, which buy even more shares. It compounds on itself like a snowball rolling downhill. And the math is honestly kind of staggering once you see it laid out. Let's say you invest $10,000 in a dividend ETF that yields 4% and grows its dividend by about 5% per year. That's a conservative assumption based on the historical dividend growth of funds like CHD. In year one, your $10,000 generates $400 in dividend income. Instead of spending that $400, you reinvest it. Now you own more shares. Next year, those shares generate even more dividend income. By year 5, you're bringing in over $500 annually from that original $10,000 investment. By year 10, it's over $800. And here's the part that makes your jaw drop. By year 15, you're pulling in over $1,300 a year in dividend income from that same $10,000 starting point. That's a 13% yield on your original investment. You started with 10 grand, and now that money is generating over $1,300 every single year, and the income keeps growing. That one shift, reinvesting your dividends instead of cashing them out, could be the difference between retiring with $60,000 a year in passive income versus $600,000. Warren Buffett, one of the most successful investors of all time, doesn't even take his dividends from Berkshire Hathaway. He reinvests every single one, and it's one of the core reasons his wealth has compounded to over $900 billion. That's not a typo. Billion with a B. Now, you don't have to go full drip from day one. Some people prefer to take dividends as cash while they're building up their position, just for the psychological win of seeing real money hit their account. That's completely valid. But at some point, once your income stream is large enough to matter, reinvesting becomes the single fastest way to grow it. So here's what you walk away with today. 3 strategies, each building on the last. Start with Dividend Aristocrats, companies that have proven over decades that they can grow their payouts through any market condition. Then level up with dividend ETFs like VYM or SCHD, which give you broad diversification and solid yield in a single, low-cost investment. And then supercharge everything with dividend reinvestment, turning every dividend check into a new vote of confidence in your portfolio. The beautiful thing about dividend investing is that you don't need to be a financial expert to get started. You don't need a fortune. You just need consistency, patience, and a plan that you actually stick to. The income you build today can keep flowing for decades, and unlike a paycheck, it doesn't stop if you take a day off. If this video gave you something useful, share it with someone who could benefit from it. Hit like if it clicked for you. Subscribe if you want to go deeper. I've got a lot more coming, and the next one builds directly on this foundation. See you in the next one.